Crystal Powell with Remax Jazz, and today I am joined with Sherry Corbitt, mortgage broker, and we're going to talk today about credit scores and how that affects your purchasing power. So, Sherry, would you like to introduce yourself?
Well, hi, I'm Sherry Corbitt, I'm a mortgage broker. I have an office in Brooklyn, and I serve all of Durham, specializing in first-time clients and clients going through separation, both of which credit seems to be a very important factor.
So, Sherry, can you talk a little bit about why your credit score is important and how it affects the purchasing power?
Well, let's talk about first-time buyers. If you're a first-time buyer, you most likely have less than 20% down. So you're going to be insured, and the insurers, which is commonly known as CMHC, have guidelines on a minimum credit score. So having a credit score gives the lender and the insurer some confidence in your ability to pay the mortgage. They do pretty much judge you based on your credit score. So good or bad, if there's some tarnishes on the credit score that we need to discuss, we do have to get through them. If your credit score is a little bit low, then the number one thing I always tell people is time is your friend, because I can help fix your credit score by giving you some coaching. Or if there's something particularly on your credit score that we can have altered or amended through Equifax, which is usually the credit reporting bureau we use, we can have that corrected and your score can make a good jump back up and you're back into the game. So time is your friend when we're dealing with credit scores. Credit scores go anywhere from about 400 to 900. 900 we actually call a unicorn because we never see them in the industry. I've pulled one in over 13 years. So a great credit score is anything above the 680 mark and above. If it's under 680, now we have some work to do. If it's under 600, then we're looking at alternative lenders only as a solution for the time being, or improving the score to what that means. Big thing about the credit scores that is if you pull your own, which you can completely pull your own, you can pull a free report through Equifax or TransUnion. You can Google them and find that. The score you see is different than the score I see. The one that I see looks at a longer period of your repayment history. So things don't fall off your credit score until 7 years for most part. So the score that I see is a little bit more of a deep dive than what you see. So sometimes clients come to me and they go, oh, my credit score is 700, and then I pull it and it might be 690. Those 10 points aren't going to make a difference, but that is why some people are like, I don't understand why there's a difference. It's because I'm seeing one that is taking a bigger picture of a longer past.
Now, is there a minimum credit score that lenders require for you to purchase property?
So if you're purchasing with less than 20% down, 620 is pretty much the cutoff. So that's the one that the insurer likes to see, 620. There's always exceptions to that. Slightly. If it's under 600, then unfortunately, no, we'll have to figure out a way to get improved from there. If you have more than 20% down payment, then there's alternative lenders, which we can go to for a year until we can fix your credit, and then back into the bank world. The alternative lenders will have a slightly higher interest rate and will have some setup costs versus the bank world, because to them, you're a little bit more of a risk because your credit score isn't there supporting that. Usually we use them as a bridge to get you back into the bank mortgage, but your credit score has to improve at that time.
Right. And so you talked about people checking their own credit report. How much damage, in quotes, does that do to frequently check your credit report? Because people are under the thought that every time I check it, it's a ding on my report. So can you explain how that works?
Yeah, no problem. So when you check your credit score, you can check it yourself if you sign up with directly with the credit reporting bureau. I believe it's once a year. So because there's two, which is Equifax and TransUnion, some people who are being very credit conscious, they'll sign up with both and then they'll pull their credit every 6 months, but one here and one here. There's no cost for that and it won't affect you. The ones that hurt your credit is when you're shopping for credit cars, things like that, and you go to 6 different stores and they pull it, then your credit score can go down.
Right.
They have modified the program that when a bank or a mortgage broker pulls your credit, it doesn't hurt you nearly the same as it would if you went and got a Shoppers Drug Mart card and then a Walmart card.
Sure. And so what is some of the simple things that people can do, sort of even before they get shopping to improve their credit a little bit?
Well, so the things that affect your credit, there's a few things, but I would say the number one thing is don't miss payments. But also it's overutilization. People don't think about that. So if your credit runs anywhere from comfortably, let's say 60% or higher of the debt, that's really going to affect you. So if you have $1,000 credit card and you hold a $900 balance, that's actually a negative. If you're over the thousand, that's even a double whammy. But if you're in that 900, 800 range, that means that you have high utilization of the available credit. There's a couple ways around that. One, spread the love out between two cards. People don't realize to do that, but it will make a big difference. So say you have $10,000 worth of debt, put it over two cards so that you're not utilizing one to the max. You've got the two. The other thing is, and especially for first-time buyers who maybe only have one or two credit cards, they're a little bit lower balance. I know this sounds super counterproductive, but it does work. Maybe ask if that credit card limit can be raised, not so you can use it, but so you can stretch that utilization. I have a client, for example, who has that $1,000 credit card. They're carrying 900 on it right now. That's hurting their credit score because it's overutilization. If that client calls TransUnion or calls the credit card company, increases that limit to 2,500, suddenly carrying a $900 balance is not a big deal. It's actually going to improve your credit score. So yes, it is.
As long as you don't use it.
As long as you don't use it, don't use that space. It is a bit of a faulty system, unfortunately, in ways like that, but it's the best system we have. So we got to learn how to play the game.
How to work it. Yeah, very good. Okay, well, my name's Crystal Powell with Remax Jazz. And if you're thinking about buying or selling, have any questions about the market or all things real estate, just call Crystal.